Hi, my name is Rajiv Rubello, and I'm the principal and actuary of Colva Insurance Services. Today I'll be covering poor valuation and fund structures in the life settlement industry. In this presentation, I'm going to draw upon my experience of having worked as an actuary within the life insurance and life settlement industries, particularly as an actuary helping to manage and evaluate a $4 billion life settlement portfolio with over 6,000 policies and over $18 billion in death benefit. This video will cover poor valuation and pricing methodologies, as well as poor fund structures in the life settlement industry that result in investors earning actual life settlement returns on investment less than what they originally priced them to be. I'm going to discuss key issues with practices such as deterministic valuation, probabilistic valuation, stochastic valuation, determining the true cost of capital, and setting premium reserves. So let's go ahead and take a look at the problems with valuation methodologies in the life settlement industry. We'll start off by talking about deterministic valuation. One of the common mistakes in valuing policies and portfolios is using solely a life expectancy and a discount rate to determine the value of the policy. This is referred to as deterministic valuation because it assumes that the time of death of the individual is predetermined. In the following example, we have an 81-year-old female who is looking to sell her $830,000 policy on the life settlement market. She has an 8-year life expectancy. In using deterministic pricing, we assume that the premiums are paid on the policy for the first 8 years, and that at the end of the 8th year, the death benefit is received. In the table below, we can see the premiums in red that are scheduled to be paid, as well as the corresponding $830,000 death benefit at the end of the 8th year. If the life settlement investor wants to determine how much to pay for the policy in order to get a 14% price return, he just discounts these cash flows at a 14% discount rate. We can see in the table below that the deterministic net present value of the future premiums at a 14% discount rate is negative $110,000, and the deterministic net present value of the expected death benefit at a 14% discount rate is $332,000. Adding these two amounts together arrives at a price of $222,000 for the policy. In the next slide, we'll discuss why it's not appropriate to discount your future premium liabilities at such a high discount rate. But for now, it's sufficient to realize that the value the life settlement investor is willing to pay for the policy in order to price it at a 14% rate of return is $222,000 if he prices the policy deterministically. However, note that this deterministic pricing does not take into account the probability that the insured lives past the life expectancy. In other words, it doesn't account for the risk that the life expectancy is wrong. If we use survival probabilities obtained by backing out the life expectancy from the Society of Actuaries 2008 VBT table, which I'll detail later is ripe with error to begin with, we can see that there is a 48% chance that this insured lives past his 8-year life expectancy, which would mean that there's a 48% chance that the life settlement investor achieves a less than 14% rate of return on his investment. And this, of course, assumes that the probabilities being used behind this life settlement investor's policy are accurate. As we'll see in later slides, these assumptions often are not. So as I mentioned in the previous slide, one of the problems in the valuation of life settlements is that the future premium liabilities are undervalued, as they are not being discounted at the investor's cost of capital. In the previous slide, we saw that the premium liabilities were being discounted at a high discount rate of 14%. However, this is only appropriate if the investor actually has a liquid portfolio that is currently making 14% and which can be used to readily draw down upon in order to make these future premium payments. For most investors, this is not the case. The money allocated to pay the premiums on this policy will more than likely come from a liquid portfolio that is making around 4 to 5% for the next several years until death benefit proceeds start materializing and will cover the future premium payments. As such, this initial premium reserve needs to be set aside and discounted at 4 to 5% or whatever the cost of capital currently is. For example, in the previous deterministic valuation, 8 years worth of premiums need to be paid before the death benefit proceeds will materialize. Where will these funds be coming from? Are they sitting in a liquid account that is expected to make 14% compounded over the next 8 years? Most likely the answer is no. These premiums are generally coming from the investor's current liquid asset portfolio, which was set aside specifically to make these premium payments, and will be earning a lot less than 14%. Failing to reserve the appropriate amount of cash and assets to pay off these future premium liabilities has been a severe failing of many life settlement firms. However, unsophisticated investors continue to discount these liabilities at high discount rates in the pricing process, while then setting aside these liabilities in low interest earning vehicles. This of course leads to the actual return on investment being much less than the original priced investment. When calculating the net present value of the life settlement investment, it's important to account for the drag that this premium reserve has on the overall economics of the transaction. However, some life settlement providers and firms try to employ a sleight of hand by showing you the expected deterministic pricing cash flows, but then setting up a premium reserve facility that severely drags down the return. So now let's look at some poor investment designs that do not account for this premium reserve drag. More than a few life settlement providers and firms utilize this type of financially deceptive structure. In the table below, we can see the deterministic cash flows for an 8-year life expectancy that would seem to indicate that a $222,000 purchase price would lead to a priced 14% rate of return. However, after the policy is purchased, the life settlement firm or provider will require the investor to set up an escrow account with $185,000 in it, which would meet the next 8-year premium liabilities. Each year this account is drawn down upon in order to make these premium payments. And of course, this account is only making about 0 to 1%. So even if the insured dies at the end of the 8th year, when you actually look back and calculate the actual return on investment, it ends up being 9% because the investor actually put this $185,000 up front into an account that was making very little interest during the time, and nothing near the 14% he expected to receive. This is one of the many flaws behind how deterministic pricing and failure to account for premium reserve liabilities in pricing leads to actual returns on investment being lower than the price returns. Probabilistic valuation, on the other hand, looks at actuarial death and survival probabilities derived from LE reports and life insurance tables. This alone is a problem, first because of the tendency of life expectancy estimates to be over-aggressive and inaccurate, as described in the second video in this series. The second reason this is a problem is that life insurance tables are built for life insurance and not life settlement experience, which is materially different. Therefore, the backed out probabilities that arise from these LEs should not be overly relied upon. Furthermore, the probabilistic valuation can mask the true risk of an investment. For example, assume you have a 99% chance of losing $1,000 and a 1% chance of making $2 million. Is this a good investment? Well, if you just do the probabilistic weighted average, it would appear so, since the expected value of the investment is a positive $1,010. However, in reality, this is a horrible investment because it ignores the tail risk that 99% of the time the investor will lose money. In essence, someone who decides to purchase and pursue this type of investment is not really investing at all, but is doing the equivalent of purchasing a very expensive lottery ticket. So let's take a look at the issues with probabilistic valuation and the problems it poses to liquidity expectations. So we can see the same table here with the premium schedule and death benefits expected to be paid on a deterministic schedule, with premiums being paid for the first 8 years and assuming that the investor receives the death benefit at the end of the 8th year. In the row below, we can see the survival probabilities of the insured still being alive at the end of each of these following years. So for example, at the end of time 0, there's a 100% chance that the insured is alive. End of year 1, 98% chance. Year 2, 95% chance, and so on. In the last row, we can see the probabilistic expected cash flows through year 8. Probabilistic cash flows after this point are not included for the purposes of this example. Probabilistic cash flows are calculated by weighting the probability that the investor has to pay the upcoming premium on the policy because the insured is still alive, against the probability that the insured has died and the investor receives the death benefit. So for example, at the end of the first year, there's a 98% chance that the insured is still alive. So to determine the expected cash flows at that time, you just have to take that 98% chance and multiply that by the scheduled $22,000 upcoming premium, and then add that to the chance that the insured has died during that time, multiplied by the $830,000 death benefit. Doing this and adding these amounts together, equals a negative $7,000 expected cash flow for that period. We can see that according to these expected cash flows, it's not until the end of year 2 that these probabilistic expected cash flows turn positive. However, we immediately see the same problem with this analysis that we saw in the previous slide. It distorts the actual risk. The only reason this value is positive is because the 5% chance of a death outweighs the expected 95% chance at the time when the life settlement investor will actually have to pay the full $19,000 premium. In order to overcome these very poor odds of a loss, you really need a large number of policies to offset the tail risk. Even 100 policies may not be enough to offset the liquidity risk. For example, assume you have 100 policies, all just like this one, and you decide to hold the equivalent of $12,000 of premium reserve for each policy in your portfolio, which would cover the first 2 years of expected cash flows until the cash flows turn positive. Even with such a large premium reserve like this and a large number of policies, there would still be a 44% chance that this premium reserve you set aside is insufficient to cover the upcoming liquidity cost, and therefore the life settlement investor would have to raise capital and funds from elsewhere in order to pay off the upcoming premium costs. And this analysis all assumes that the probabilities being used are accurate, which, as I mentioned in the previous slide, is often incorrect because of the improper use of life insurance experience to estimate life settlement experience. Stochastic valuation uses simulations based on the underlying data to help develop a distribution of returns based on the underlying probabilities. While this is an improvement over probabilistic valuation, as it gives a better understanding of longevity risk, it's only useful so long as the underlying data and probabilities are accurate. In other words, garbage in equals garbage out. Using unrealistic life expectancy and premium assumptions to perform stochastic valuations doesn't help understand the risk of investing in life settlements any better. All it does in these cases is offer a clever magic trick to hide the illusion of risk under the wizardry of financial modeling techniques. The extreme value of investing in life settlements often gets lost behind poor valuation metrics and dubious ethical practices in the industry, like the ones I've illustrated in this presentation. At Colva, we utilize our actuarial and insurance expertise to help those investing or considering an investment in life settlements to design an investment structure that helps realize the full extent of this underlying value. Colva's life settlement services include assessing appropriate mortality assumptions and determining the appropriate premium reserves to hold. We also properly optimize premiums using hidden actuarial features like shadow account pricing and other actuarial features that help maximize value while reducing longevity risk. Finally, Colva handles all basic policy servicing behind life settlement investing, such as ensuring that premium payments are made as scheduled, collecting death benefit proceeds, and tracking the health of the insureds. So as I mentioned, all of the knowledge and expertise I've provided in this presentation comes directly from my experience of having worked as an actuary in both the life insurance and life settlement industries. So let me just spend a brief amount of time talking about my experience of working in these industries. For those unfamiliar with the actuarial designation, an actuary is a financial professional who uses both statistics and mathematics in order to make life insurance products profitable. I started my career in the pricing and design department of New York Life, where we studied mortality statistics and patterns and used them to help determine premium structures for New York Life's various products. It was here that I helped teams that priced and designed policies and also helped build illustration systems. I then built on this experience by working within an insurance and investment unit of AIG, where I helped to manage and evaluate AIG's $4 billion portfolio of over 6,000 life settlement policies with over $18 billion in death benefit. One of my key accomplishments here was using my pricing and design experience from working within the life insurance industry to develop a top-of-the-line reverse engineering protocol that determined the minimum premiums to pay on a block of 200 policies. By using complicated features such as shadow account pricing and no-lapse guarantees, I was able to provide over $20 million in added value and minimize premiums. At both New York Life and AIG, I noticed key flaws in their mortality tables that were later incorporated in revised mortality tables. Well, that concludes our presentation. I hope that the information you found here has helped show you some of the flaws behind valuation practices in the life settlement industry. If you're investing or considering investing in life settlements, We also hope that you'll consider Colva's vast actuarial and insurance expertise in helping your team accomplish these goals. We can be reached by phone at 1-800-561-4028 or by email at lifesettlements@colvaservices.com. I'd also encourage life settlement investors to check out our website at www.colvaservices.com, as you can find a lot of great information, articles, and videos about the life settlement industry, as well as detailed information about all of Colva's life settlement services.